Hello, everybody. Thank you for joining us for today's public webinar. Jim was going to be discussing results of PCE. Hope you all have been having a great summer. Good morning, Jim.
Good morning. Good morning. Okay, there's several things going through my mind this morning. One is a kind of a bigger picture item. I've been trading for over 50 years, and I don't remember exactly what period it was, but when we had stagflation. There's many different ways, many different definitions of stagnation, stagflation, depending on where you are in the economy. But where we are right now, the possibility is that what we get is a combination of inflation that runs stubbornly high combined with weak growth. Oh, I'm sorry. Combined with deteriorating underneath economics. It's called stagflation. Now, this is what they've declared, and I've only heard it a couple times, but this is what they've declared in Germany. And stagflation, I can't remember the exact period, but it was a terrible, terrible time in the markets. But I think that's one of the things that we're facing as a possibility now. The Fed was at Jackson Hole. Powell was pretty firm about they're going to stay the course on inflation. And keep in mind, it's just like as we do as traders, we know how much psychology plays into what we do sometimes. Well, remember, Powell started his tenure out with a terrible mistake on the markets, that saying that this inflation was transitory. So it was just a huge mistake to start with. Now he's on course, and he's, I think, by all reports, have done a pretty good job. However, think about it as a human being. If he gives up on inflation too soon, and historically, one of the things that has happened in the markets historically is that the Fed and the market has declared inflation over too early. And that's been a kind of a painful period. So I think that's something we need to keep in the back of our mind right now. The second thing that I want to kind of address this morning is that we are, in kind of a maximum holiday period. We've got, a holiday on Monday. We are at this is the end of the month. And a lot of the big money is on vacation or not trading. The volume on the last 3 days, as the market has skyrocketed up, has been very anemic. That is not a particularly healthy sign. So the inventory inventory is long from overnight. We know there's about a 70% chance that we get a counter auction to short-term inventory. If you don't get that counter auction, that's a sign that the market's got some strength to it. But so far, we had a potential for a gap. We've got about 25 minutes till the market opens. We have a different picture on the NASDAQ. The NASDAQ is substantially weaker, and of course, it's been a lot of the movement of the tech stocks that's driven this market recently. And we're, of course, showing some give back here on the ES. It's a very difficult, dangerous market to trade when you're coming into the last day of the month. You can get adjustments, you got vacation, extremely treacherous market. What I have seen is that there has been mostly driven by short-term traders. One of the indications that tells us that it's mostly short-term traders, there's actually two. One is that the volume is so very, very light. But secondly, this has probably been the greatest number of anchor trades that I have seen in some period of time. And when we see anchor trades are an indication of short-term trading. Yesterday morning's pullback, and let me see if I can take you to yesterday's there's yesterday's pullback was at 45.01. That is a weak low because it's within a tick of, the magical 4,500 even. That is also an anchor trade because, short-term traders bought it, almost exactly at 4,500. When we see that kind of behavior, that is the behavior that is normally associated with very short-term traders. Larger institutional money does not buy at exacting levels. As if you've been with us before, at one point in my life, I ran an institutional trading desk. And, when you get large institutional orders, and even now they may do them electronically, but their size is too big. They don't execute at exacting numbers. There may be some CTAs using some programs that may mechanically do that, but generally that's a sign of weaker hands traders, or what I call the very short-term traders, which is pretty common because right now we know it's a holiday period. We know the volume has been exceptionally weak on this kind of really huge run. And the run itself started from just a couple of ticks above the 100-day moving average. So where we are this morning, we're coming into this morning, there's the settle from yesterday. Overnight inventory is long. We are getting some counter auction, right now. But it's the last day of the quarter. The last day of the month. And I think anything goes in here. There is absolutely no disgrace in saying markets can be very uneven, and there's no harm in just saying, I'm going to sit this one out. I've been very, very cautious the last few days in the market. They're treacherous markets, and they're very thin. So let's go back now. The reason we do these sessions is to introduce you to the educational programs that we conduct. The next program is the fall intensive. And when does the fall intensive start, Jen?
It starts on October 4th.
Okay, and it's about 60 hours of training that we go through. There is a prerequisite to the intensive, and the prerequisite is that you have to have been to a previous intensive, or you have completed the foundational e-course. Now, commonly we get all kind of people balk at the requirement for the foundational e-course because they say they've been trading market profile for years and they've watched all my videos on YouTube, etc. And early on, when we first started this, we did let people in that hadn't had the foundational e-course. And that really was a bad decision on our part because people really don't know what they don't know. And just because they've been exposed to market profile, they think it's the same way we look at it. You start off and understand, we are not market profile traders. We use the market profile to organize the market's continuous two-way auction process. Once the market is organized, the data is organized, it is easier to tease important information from that data. So we that is a requirement that we have. Jen, you want to just kind of walk through briefly the intensive
Yeah,
foundation
just
league
for
course?
folks that are newer, I will just let me show them where you find the information. Okay, can you see my screen? So you
Yes.
just go to our website, jimdallantrading.com, and go to courses at the top navigation, and you're going to see that the fall intensive is featured up at the top. I've had people question, what are the timings of the webinars? So we've posted the schedule there, and here you can download this or print it out. The times are posted in Eastern, but you can change for your time zone. And you'll see that we're doing this intensive a little bit differently. We usually have our 2 book discussions, but we're kind of doing that earlier on simply because Jim wants to interweave some important points, psychological points that we think are important to hit early on, and make sure that we interweave that throughout the intensive. And we've also will be updating some of the presentations that we do. So if you've joined us before for an intensive, just understand that this one's going to be different in that we're updating certain things and going to have some other newer presentations. And for the prerequisite requirement that Jim is talking about, the Foundation E-course, we do currently have limited time discounted bundles that include both courses, and you get a nice discount. Purchasing earlier on will always yield you the best price. And basically, I just want to mention that our current sale pricing, it was supposed to go up after this past Sunday, but we decided that since it's a holiday week, we wanted to extend it through Labor Day. So the current sale pricing that you see is going to end on Labor Day, Monday, September 4th. But here's the bundle that has both the Foundation e-course and the intensive. So if you haven't done the Foundation e-course, you want to join us for the live intensive, this is going to be the bundle that you should purchase and also get a discount while you can. And for those of you that have not done the advanced nuances and exceptions e-course, because I've had some people ask about that. That bundle is right here and is currently on sale as well. So if you have any questions about what's right for you, you can always contact us at the phone number at the bottom of our website. Be happy to speak with you, or you can shoot us an email at dalton@jimdaltontrading.com. And let me give you back the screen, Jim, so you can get back to market. And if you want, we've got some questions. One question that I do see here, somebody is just asking about 45-degree lines. And I
Are we
just
showing
wanted,
my screen?
well, hold on, I just wanted to point out that that's a more advanced concept, and that I believe is covered with examples, several examples within the advanced nuances and exceptions e-course, okay? Okay, Jim, let me give you the screen. There you go.
Okay. So
Okay.
go take some questions.
Yes. Somebody is asking, yesterday's cash profile was a 45-degree, and the composite for yesterday and Tuesday looks like a P shape. Would Jim comment on either of those ideas?
I don't look at the cash market. I went through that for years with a couple of institutional friends of mine, and they finally at the end agreed that that I was in a better position by using the futures. So, but I think that this market got terribly short when it broke, and then we've had, I think, a very fierce short covering rally in here. And a lot of times what happens in these rallies, they keep going because people short into the rallies. So people say, well, how can it still be a short covering rally? And part of the reason is because people short the rally and they have to cover. They short the rally and they have to cover. One of the things that we talk about in the educational courses is probably the single biggest error that traders make is fading trend days or fading, big moves to the upside. And this has been a big move to the upside. And there's been a tremendous amount, from at least what I can see, a lot of short-term traders have faded that market or gone against it, only to be forced to cover. And when you get the momentum, it is a momentum market. When you get the momentum, whether you like the market or not, you don't go against it. You are so much better off to be a little bit late rather than early. And when we're talking about that, a lot of times,
Jim, I'm sorry to interrupt, but the person just came back to clarify that they meant the pit session, not the cash session.
I don't see a 45 anyplace.
Okay.
I don't see a 45-degree line in there. I mean, I don't even see something close to resembling a 45-degree line. Okay. The thing that I been going through my mind as we're getting ready for the next intensity, a lot of times, people sign up and join our courses because they've been unsatisfied with their trading. And a lot of times they expect to, an early turnaround in that habit by taking these courses. Understand, if you have been unsuccessful with your trading, that is something you have learned. You have learned how to do it that way. And in the process, you've formed some bad habits. In other words, you've learned how to be a bad trader. And that is the concept that most people really don't appreciate. And when you think about when you learn something, how difficult it is to unlearn it. And that's what a lot of people that come to these courses are facing, is the unlearning process of a lot of bad habits. And what people have a tendency to do is they pile on top of what they already do a lot of the things that we address. And that complicates that makes your challenge even greater. Unlearning is probably, if you've been successful with your trading, now coming to us can work as a positive add-on. If you've been unsuccessful, coming to us, you have to understand it's a two-step process. You have to unlearn an awful lot of what you have undertaken. Then you have to build a new base to it. And that is a very big challenge. It is hard for people to do. It is hard to give up what you've learned, even if it's not producing the results you want. Okay, other questions, Jim?
Yes. Okay. Somebody was asking me about, is September enough time to go through the foundation e-course in time for the live intensive? And my answer to that is that, the course is over 11 hours in length if you didn't pause it, and you definitely need to go through it, multiple times. But if you've got the time to commit to do it, then a month is definitely enough time to be able to go through that more than once. It really depends on how much time of your days that you can commit to going through it. But it is very feasible. And I will say that we don't always offer these discounted bundles. They're only when we are marketing for a live intensive course. So that's only 2 to 3 times a year. And they won't be available much longer. I want to say probably about 2 weeks before the intensive starts, they won't be available anymore, because we know that it's not likely that somebody will have enough time to really go to really get through it. Okay. Okay, another question here. Tuesday's rally on the NQ started from almost exactly the July low. Would you say that makes it a weak low, or has this level been traded through too many times to have any significance?
No, when it starts from that, remember, yes, it's a weak low, but it's only one data point. Too many times we make too much out of that. But what's more important to me than anything is when it starts from those exacting levels, that is usually an indication to me of who I am competing against. Like I say, that is unlikely where institutional money or larger money would start to trade. That is the money that momentum traders, shorter term momentum traders, and maybe some CTAs will trade from from those levels. But when I look at these where rallies stop and start and references stop and start, it helps me identify who I'm competing against, and who I am competing against greatly alters what kind of trades I'm going to do throughout the session. For example, I started off this period by saying that it appears to me that what we've seen for the past 3 days has been mostly shorter term traders, and shorter term traders are the traders that, what I call the anchor trades, and constant references from the anchor trade, as we said yesterday morning, right from the 4,500 level. When I see that, that tells me I'm probably competing against very short-term traders. They trade differently. They trade differently than do longer-term traders. It's like I say, when I played sports for a number of years, I played a lot of racquetball. You have to know, are you playing against a left-handed or a right-handed player? Who you're competing against makes a tremendous difference. All right, so we've got just a few minutes till the market opens. So you see the settle, and the settle, we calculate overnight inventory from the settle. So overnight inventory is long. We have had some counter action to overnight inventory, so that has relieved some of the pressure, but overnight inventory does remain long. The odds are 70% of the time you get a counter auction relative to overnight inventory. So if overnight inventory is long, the counter auction would be selling. If you don't get that selling, then that's an indication that the market's got at least some short-term strength. Now, in addition to that, remember, this is the last day of the month. An awful lot of the bigger traders are on holiday, and their trading desks are manned by, the number 2, number 3 person in there. So these are very dangerous to markets. They're thin, and as I say so many times, the adults aren't in the room. Okay, couple last questions.
Yes. Is the market likely to be more volatile for employment news tomorrow since the market is closed on Monday?
I don't know if that's the case or not. It's probably likely to be quiet. The activity will probably be around the release of the number, but the floors, all the traders, will clear out pretty quickly. And, probably by, noon or so Eastern time, the markets will be pretty quiet. So I really don't know. Remember, it is a dangerous time in these markets. There may be nothing that happens, but if something happens, they're very thin. And we saw that yesterday. We saw some wild moves up and down yesterday. They were just all very short-term driven. Okay, another question.
Okay. You answered, because another person was asking, did you see a 45-degree line yesterday from the high to the point of the control? But you mentioned earlier that you did not see one yesterday.
I don't see it at all, no.
Okay, somebody's asking, is the overnight inventory almost corrected since we're at the lower end of the overnight range?
No, you've had some counter auction, some correction, but no, it's not. Okay.
Okay. And somebody was asking, how can you not be a market profile trader when you execute trades against levels such as the week low that you had mentioned?
The week low has nothing to do with with the market profile. It's just an observation to say, that has nothing to do with the profile. It's just that was the low. And I see the low is, whether you have a market profile or not, the low is at 4,500 or just a tick above it or so. And when I see that action, that just communicates to me that I'm dealing with short-term momentum traders, whether I have a profile or not. So okay, other questions?
And I'll just add in that, Jim identifies himself as a discretionary trader that utilizes the market profile because it organizes the data of the two-way auction process. So hopefully that clarifies that. The overnight market on all the days this week have stayed in the upper value area of the cash session. Is this a sign of a bullish market, or is it the short time traders without big money?
I think it's a momentum. I think it's a momentum driven market, mostly driven by shorter retail traders. Remember, it started from just a couple of ticks above the 100-day moving average. We went through this scenario. First, everybody was focused on the 50-day. And if you remember, I think 11 out of 13 days, the 50-day moving average was the exact lower within a tick of it. Well, then we broke through that and got liquidation. Then the next thing was short-term traders were focused on the 100-day moving average. We went down one time and bounced off it, went down a second time, and just a couple of ticks above it, bounced off it. So that became the new game, the 100-day moving average. When I see that exactness, I look at it, 100-day and 50-day averages, and those are what's driving the market or the reference point. That is usually an indication to me that it's shorter term traders. Now, you can make a terrible mistake if I don't laugh that off. That's just simply an observation. And they trade differently. You know, a right-hander plays differently than a left-hander. So you have to know who you're competing against. Who you're competing against will give you an edge in the market. So that's all. But then I look at the volume. The volume on this big rally has been very light, which is more an indication it's been probably shorter term momentum traders. There's been no real backing and filling as this market's gone up, which is dangerous if the market starts down. Okay, final question.
Okay. Was that a long liquidation yesterday? Did the market get too long at the open?
Oh, I think so. Yeah. Inventory got very long. You got the liquidation, and then they were buying it exactly at the 4,500 level or within a tick of it. Yeah, I think so. All right. Thank you very much. And I do hope you join us for some of our programs. And remember, learning to trade is it's a lifetime undertaking. But so many times, if you've not been satisfied with your trading, it's very hard for people to address. But the first thing is to unlearn an awful lot of what you've been doing. Thank you very much. Have a great session.
Have a great holiday weekend, everybody, and we'll see you at the next webinar. Thank you so much. Take care.